Okay, I'm going to continue with working capital and current assets. This is 5.1. We have internal issues, so I'm going to continue with this, and then we're to continue with another part. Okay, total assets. The total assets decreased in 2020 because the inventory was higher in 2019. The cause of this was Comvita had a lot of sales because of the pandemic. Was a good thing for us because the online channels start selling a lot of things. So for Comvita, the pandemic was good. Total liabilities was also really good for Comvita because they reduced their liability in almost 50%. The reason of this was they asked for a loan to the Westpac Bank on 2019, and they paid all their liability, all the loan in 2020 because they had a lot of good sales because of the pandemic. The finance cost remains stable. As Carol said, the inflation here in New Zealand was stable, so that was good for Comvita. So the finance cost remains stable because of this risk. As I said, the pandemic was really good for Comvita. Comvita is an essential business in New Zealand. So the demand of sales in online channels was really high, not only in New Zealand, also in China. So the assets start to be really, the assets was good. However, the company had a loss. Like we see in the balance sheet, it was a good year, but the company had a little bit of loss. Comvita created a lot of new opportunities in the pandemic with the demand on the online sales. Okay, I'm going to continue with capital structure, risk and capital budgeting. Based on Comvita cash flow pro forma analysis, investing in Comvita is safe, but however, the increased revenue year per year doesn't show a high growth. So it is stable. They are not going down, but the growth is really, really tight. So you can invest there, but you are not going to see a lot of money. The reason is because, as you know, and we told you last presentation, Manuka flowering period is so little. So the Comvita doesn't have all the product to supply the demand. That's why the growth is not so big. Okay, so this is the annual cash flow, the value cash flow, and the discount payback year 1 and 2 was the same for the 2 years. So they are going to start seeing like all the revenue in 6.3 years. Okay, our new project, Comvita, they don't invest a lot of money in marketing because the brand image is so good and everybody knows about the products and the premium of the quality of our products that they don't invest too much in marketing. But our project is to get big the channel distribution, and the plan is to invest in retail industry. In Asia, they have some kind of kiosk in the malls and in some airports, things like that. So we're going to put the same kiosk here in New Zealand, for example, in Commercial Bay, in Newmarket. And Comvita is going to invest 20,658 New Zealand dollars. This is in thousands. And the expected cash flow for the next 5 years is going to be this one. And the growth rate is for 14.5, like Gabriel said at the beginning. So at the end, it's going to be 45,819. This is our project. Okay, the present and future value. As I said, this is the present, and this is the future value. And the rate was negative because, as I said, the payback, they are going to recover the inversion in 6.35 years. And this was for 5 years. That's why the rate is negative. Okay, the risk. The big risk of Comvita business risk is the weather conditions. If the weather conditions are not good, Comvita is not going to have a good yield. And that is going to affect everything. In 2016 and 17, the conditions were really bad in, like weather conditions were bad here in New Zealand, so the yield was bad. And another risk is the market risk. If there's any economic recession in the world, they're going to affect like the income for our customers, and we have a premium product. So if something happened, inflation, COVID, an earthquake, that is going to affect us directly, because the people is going to focus their incomes to buy cheaper products. Thank you.
Understand? I think that's